All right. It's J-Rod and welcome to Stocks That Rock. Each week, I turn up the volume on a breakout stock that will rock your retirement account. I've been on assignment for the last few weeks, but I'm back with what could be my most important video of the year. As you know, the Federal Reserve has committed to raising interest rates to combat soaring inflation. And as a result, stocks have cratered in the last month. You've probably heard that high interest rates can have a profoundly negative effect on stocks, but there's more to the story. I've just completed a huge back study on stock market returns during cycles of Fed interest rate hikes over the last 32 years. And what you don't know about stocks and interest rates can hurt you. So I'm going to set the record straight. Today, I'm going to show you the secret to stock market survival in a rising rate world. When it comes to interest rate hikes, there's good news and bad news. But before we get into the results of the back test, let me show you how I ran this study. From the Federal Reserve's website, I pulled all the Fed's rate actions going back to the 90s. Their website sucks, so it was a real pain in the butt. However, as you'll soon see, well worth the effort. Next, I pulled the S&P 500 individual sector data for all 11 groups going back to 1989. One caveat here, the real estate sector group was established in the year 2000, so on the stock charts you'll see in the moment, the returns for that sector only capture price action over the last 2 rate hike cycles. Finally, using the stock returns and hike cycle periods, I drew up a composite map of how each stock market sector reacts in the 1-month, 3-month, and 6-month period following the first hike in a cycle. Easy enough, right? Cool. Since 1990, there have been 4 true rate hike cycles: 1994 to 1995, 1999 to 2000, 2004 to 2006, and 2015 to 2018. Now, remember when I told you I had good news and bad news? Well, let's start with the bad news first. After the first hike, all 11 stock market sectors are down after 1 month. Financial stocks, healthcare, and material names take the biggest beating of the bunch. And 3 months from the first hike, only 3 sectors are positive on average. These 3 winners are communication services, energy, and real estate. And as you can see, those 3 positive sectors aren't really up by much. But here's the good news. 6 months out from the first hike, only 3 sectors are negative out of 12. In other words, stocks normally get rocked in the first month of a rate hike cycle, but recover sharply 3 to 6 months out from the first hike. So how can you use this data to survive the slaughter? Well, for starters, you may want to trim your holdings of financials and healthcare stocks before the hikes really get going. These 2 sectors typically fall sharply after the first hike and remain weak even 6 months out. On the other hand, you might want to buy the dip in real estate and technology stocks in the first 30 days of the cycle. Real estate is the first sector to recover after 3 months and the strongest sector after 6 months, up more than 10%. Which makes sense since real estate stocks aren't volatile and they pay out big dividends. Tech is typically a bit slower to get back on its feet, but it's the second best performing sector behind real estate. And tech is already cheap after the January sell-off, so there's some real bargain names out there. Though I would avoid tech names that are not already generating sales and meaningful profits. So to sum up, yes, stocks are typically weak in the first 30 days of a rate hike cycle, but they often recover sharply 3 to 6 months out from the first hike, with real estate and tech stocks leading the way. So consider buying the early cycle dip in those 2 strong sectors when hikes kick off probably in March. That's all for today, but as always, if you dig the content, please hit the like button and subscribe to the Rich Retirement TV channel here on YouTube so you never miss out on my videos. And if you've got a question or comment, leave a note below this video or shoot me an email at askjrod@stpaulresearch.com. Thanks again, and for Rich Retirement TV, I'm J-Rod, and I'll see you next time.